Welcome to LR Reports. This channel focuses on institutional research that I've personally reviewed. As a fund manager and family office analyst, my role is to filter through a large volume of research and focus only on what truly matters. AI helps structure and deliver the content efficiently, but the selection and interpretation are human.
Welcome to The Critique. Today we're doing a forensic analysis of the Goldman Sachs Asia, China Games and Entertainment 2026 Outlook.
Right. This one was published January 19, 2026. The team was Lincoln Kong, Ronald Kyung, and Lu King Zhou.
And this is a really heavy-hitter document, especially given the timing. I mean, we're looking at a sector that just came off a massive heater in 2025.
That's the critical context here.
Absolutely. To set the scene, large and mid caps in the sector rallied, 50 to 80% last year?
Yeah, way outperforming the HSCEI. And 2026 has already started hot. Some of these names are already up another 30%.
Which brings us to the immediate tension in this whole thing. The easy money, that beta rally.
That's been made. Arguably, the market repriced the recovery.
So the core question for us is, why stick around? Is there actually any meat left on the bone here, or is this just chasing momentum at the top?
And that's exactly what the material gets into. The argument seems to be we're transitioning from a beta to an alpha market.
It explicitly says the risk-reward is still favorable, but it's no longer a rising tide lifting all boats. It's about specific structural shifts.
Right, and that's the key divergence from consensus, I think. After an 80% rally, consensus usually starts screaming overheated. But Goldman is arguing that this is justified. It's justified by two things the market is underpricing.
AI penetration and overseas expansion.
Exactly. The new growth narratives. They're trying to pivot the whole story away from just China reopening.
And focusing on companies that are breaking that domestic ceiling.
Which brings us to the overseas arbitrage point.
Yeah, let's dig into that. They highlight this fascinating valuation disconnect with NetEase. Right now, NetEase generates less than 10% of its revenue from overseas markets.
Which is nothing. You compare that to Tencent at over 30% or their Japanese peers,
Who are often at 50%. And because of that low mix, NetEase trades at a pretty significant discount to that peer group.
right. But the whole thesis here is that this is backward looking. Goldman's model shows a rapid shift.
A jump towards 20, maybe even 30% overseas exposure in the medium term.
And they're banking on two specific titles for that, Sea of Remnants and Ananta.
Which feels like a classic event-driven setup, right? I mean, what if you focus too much on the pipeline and overlook the execution risk?
Well, if Sea of Remnants underperforms, that multiple expansion it evaporates.
Sure, but I think they try to mitigate that fear by pointing to the broader trend.
The 6 out of 15 number?
Exactly. In the second half of 2025, 6 of the top 15 mobile titles globally were from China. The argument is that Chinese publishers have a structural advantage now.
Capital intensity and talent density.
Right, an advantage that Western studios are struggling to match.
That capital intensity argument is strong. I mean, Western studios are cutting costs, laying people off. Chinese studios are still shipping these AAA mobile experiences at a pace the West just can't match.
Okay, let's move to the second pillar of their alpha thesis, AI. And this isn't just, we use AI to code faster.
No, this is the Kuaishou re-rating. This is the part of the report that really fundamentally changes how you have to value the equity.
So the theme is a shift from AI as a cost saver to AI as a revenue generator.
Right.
The analysts have upped their revenue forecast for Kuaishou's video model, Kling, to what, $280 million for 2026?
US dollars, yeah. And an ARR, annual recurring revenue, of nearly $400 million by year-end.
That's aggressive.
That puts in serious software company territory.
It does. They're effectively valuing Kling as a standalone unicorn inside of Kuaishou. They're saying the current share price implies a $6 billion valuation for Kling alone.
And they're putting it up there with Sora or Runway. But what if we look at the core business? The report mentions Kuaishou's ad growth is slowing to 10%. So they're basically saying, buy the AI optionality, ignore the slowing core.
I think that's fair. They're telling investors to stop looking at DAO as the key metric.
And start looking at AI revenue.
Exactly. If Kling hits that 400 million ARR target, it validates the whole AI as product thesis for the entire sector.
It's a high-stakes assumption, though. They're assuming a 10x TAM expansion for AI video tools by 2028. If that adoption curve flattens, Kuaishou looks stretched.
Okay, so that brings us to the elephant in the room.
The ByteDance threat. You can't talk about this sector without addressing it.
The report handles this with a lot of nuance, I thought. It doesn't just say ByteDance wins everything.
No, it segments the battlefield. They concede ByteDance is winning in short drama and minigames.
Gaining clear share there, and obviously dominating short video. But, and this is the key distinction, they argue incumbents are safe in music streaming.
The Soda Music versus TME debate.
Right. So, the report acknowledges Soda Music has hit about 20% market share in MAUs.
Which sounds terrifying for a TME investor. Usually, when a ByteDance app hits 20% share, the incumbent sets to die pretty quickly.
It does, but Goldman argues the user overlap is only 20%. They think TME has differentiated itself through non-subscription revenue.
Merch, offline events, sponsorships, that kind of thing.
They see TME becoming a superfan platform, while Soda is just a casual listening utility.
Okay, but what's the fragile point in that thesis? The report notes Soda is a freemium model right now. What if they turn on the monetization tab? What if they pivot to premium?
That's the risk. If Soda pivots effectively, TME's valuation, which is already derated from 25 times to, 17?
Around there, yeah.
It could collapse further. But the authors seem confident that the fan economy moat is deeper than just streaming songs.
It's a bold call. Don't worry about the fast-growing competitor because our incumbent sells concert tickets.
Speaking of which, let's hit the policy angle. The report references the 21 measures from August 2025.
The supply-side revitalization.
Right. The assumption is that regulation has shifted from restriction to support. They specifically mention the unofficial lifting of the K-pop ban.
That is a significant signal.
It is. The logic is that rich content supply stimulates demand. But is there a risk that this overlooks the structural decay of long-form video?
Well, the report admits short drama is eating long-form video alive.
The data point they use is striking. Hongguo, the leading short drama app, has double the DAUs of IQII or Tencent Video.
Double. That is a staggering statistic. So while policy might be supportive of long-form TV, the audience is just
leaving,
which suggests traditional players like IQII could be value traps unless they pivot. And that links back to the whole stock pickers market theme.
You can't just buy the ETF anymore. If you do, you get the dying long-form players along with the AI winners.
What about Bilibili? They have a buy on it based on a margin turnaround.
Yeah, forecasting ad revenue growth near 20%. But Bilibili is a high beta play on ad budgets, and it's under-monetized. They mention it's at roughly 27 RMB per mile versus Kuaishou's 112.
That's a massive gap. The bull case is, look at the upside. The skeptical view is, why haven't they closed that gap yet?
So if the macro environment compresses ad budgets, that efficiency gain might just not materialize.
It feels like the most macro-sensitive pick of the bunch.
Okay, I want to touch on a new concept they introduce, GEO.
Generative Engine Optimization.
Right, moving from SEO, keywords, to GEO, which is citations in AI answers.
This is a critical structural observation. The report is warning that ad budgets are going to shift from search engines to AI assistants.
So it's not about ranking number one on a list of links anymore. It's about being the entity the AI trusts enough to actually mention.
Which favors platforms with structured, high-authority data. Another reason they like these walled gardens of content.
Okay, let's synthesize the top picks. They're recommending Tencent as the foundation.
The safe haven. Stability, dividends, 30% overseas rev.
Then NetEase is the global catalyst play. You buy it for that multiple expansion story.
High risk, high reward on execution.
Kuaishou is the AI alpha, a venture capital bet inside a public company.
Yep. And Bilibili is the margin turnaround, the efficiency play.
And finally, TME as the oversold defensive.
Which works as long as that Soda Music threat stays contained.
So, looking at the big picture, the message to the investment committee is clear. Don't sell the sector just because it's up 80%.
But don't buy the index. If you buy the index, you're buying the losers of the ByteDance war.
You have to buy the companies exporting to the West, like NetEase and Tencent, or the ones building the tools of the future, like Kuaishou.
And avoid the ones stuck fighting a losing battle for domestic eyeballs.
Unless they have that very specific niche, like TME's fan economy.
The logic is robust, provided those new narratives actually convert to cash flow.
And provided Sea of Remnants isn't a flop.
And Kling isn't crushed by a leap from OpenAI.
Always the risk. Now, for our listeners, the actionable takeaway here is to scrutinize your portfolio for beta versus alpha exposure.
And watch the AI native metrics. Stop asking about DAU for Kuaishou. Ask about ARR for Kling. That is the metric that matters now.
And that valuation gap between Tencent and NetEase, if it narrows, the thesis is working.
One final thought on that domestic ceiling. The report says Chinese publishers have less than 15% of the global ex-China market. That is a $150 billion opportunity.
If they move that needle to 20%, that is billions in high-margin revenue. That's the macro story supporting all these micro stock picks.
A compelling argument for staying invested, but selective.
Indeed. That brings us to the end of this critique. We've broken down the Goldman 2026 outlook, dissected the pivot from beta to alpha, and analyzed the key risks.
A very focused, very actionable piece of research.
We encourage you to submit your own research or thesis for future critiques. We'd love to see how you're positioning for the year ahead.
Absolutely. Send us your work. We want to help you sharpen your edge.
Until next time.
That's how we approach research internally. Filter first, then analyze, and only then decide what's worth sharing. If you find this useful, feel free to follow the channel. I'll see you in the next episode.